You remember we talked about fraud, right? We talked about controls, discussed in general controls, and I talked a lot last week about continuous control and continuous control monitoring and continuous auditing. Just to let you know, this is not included in the exam. The continuous control part of it. So the continuous control, continuous control monitoring, continuous auditing, which I discussed, and this is the type of research that we do at Rutgers, that's not going to be on the exam. Okay? And I believe we stopped here. We discussed cash receipts. Okay, now we'll talk about cash disbursements. This is when the company pays cash. Okay? And again, this is a very important part for the company. It's a high-risk area of the company. Why is that? Again, because cash could be easy. Sorry, Lauren, go ahead. Cash is easy to steal. So if you are making a payment, it's very easy to pay yourself or your friend, etc. So there are usually companies when they make payments, they use a voucher system. This is like a series of approvals. However, in certain cases, they use what we call petty cash funds. Petty cash funds are usually used for small payments, very small payments, where it doesn't make any sense to go through an approval. For example, if you're, for a certain reason, you're buying like pizza, you're not going to have a series of approvals to buy pizza, right? Or to pay transportation. So this is where companies, instead of going through the voucher system, they use petty cash funds. So let's see how this is done. The controls, the 6 principles that we discussed earlier for cash receipts, they are also there for cash disbursements. For example, establishment of responsibility. If I'm the only person, let's say that I'm the treasurer, and I'm the only one who has access to the checks, any check that goes missing will be my responsibility, right? I did not keep it, I did not take care of the checks. I left the drawer open, or I left my office open and someone stole that check. So in this case, it will be easy to establish responsibility for any missing cash. If I am the person who is dealing with who's paying or sending out checks, etc., I'm responsible for it. When you talk about documentation, again, checks must be numbered. You're sending out a check, that should be numbered. Okay? And they should all be accounted for. If the check goes missing, the company needs to find out where this missing check went. Okay? Because if you hide a check, you could pay it later on to yourself. So checks must be accompanied also by, let's say, purchase orders or invoices. So why are you paying? If you pay someone, there must be some kind of documentation to mention why are you paying. Like, for example, an invoice, an approved invoice. And again, it's not just an invoice. It has to be an approved invoice. You have also segregation of duty. The person who writes the check should not be the same person who approves the check. The person who makes the payment should not be the same person who is approving that payment. Okay? Once again, we have HR controls, independent verification. General auditors, they always check this kind of information if the company actually, if the payments were really approved or not, etc. And you also have, of course, physical controls, like keeping checks and cash in safe or vaults and stuff like that. So the cash disbursement, when the company is using the voucher system, it starts, this is like I mentioned, it's a series or a network of approvals. Okay? So it starts with the company, for example, they start with this voucher. First thing they do is they fill in the liability information. Remember, when the company receives an invoice or they make a payment basically, before they make a payment, they have a liability. They purchase something on account, right? You purchase something on account, that's accounts payable. That's a liability. This is where it all starts, right? So the company would fill in the information, this voucher. This voucher is then sent to accounts payable employee to enter it in the register, right? To record that voucher, to record that we have a liability, and this is the record of the liability. After approval and everything like that, if everything is approved, a check would be issued and sent to for example, the supplier, or to the vendor, or to whomever we are paying, to the company we are paying. So you check is issued and it's sent on the due date. At the same time, once the check is sent, the company would stamp the voucher as paid to avoid paying the same voucher twice. Okay? Once it's stamped paid, this is it. And then it's sent to be recorded in the accounting department. That means that the payment, this is the payment of that purchase order. So for example, let's say that you purchase something on account. This is where it starts with the liability. It ends with the accounting department recording the payment. Okay? You purchase something, it becomes a liability, and this is where the voucher starts. And then you record that liability on the date it's due or whenever the company is going to make the payment. The check is issued, the voucher is stamped as paid, and that voucher is sent, and then the check is sent to the payee, the company, let's say your supplier, and then finally the voucher, the voucher that was stamped paid will be sent to the accounting department to record the payment. Okay? Okay. When you have only the designated person handling cash receipts, that will be establishment of responsibility. Okay? Segregation of duties is when you have two persons, for example, two separate persons to for example, receive cash and to handle the sales revenue information. Okay? Someone would handle the cash register tape, the other one would handle cash itself. This is for segregation of duty. So the use of pre-numbered checks in dispersing cash is an application of which principle? You're improving. Now we get to petty cash fund. Now petty cash fund is, like we mentioned, this is done usually for small payments where it's not efficient or useful to actually go through the voucher system for such small amounts. Okay? It involves basically 3 steps. First one is when the company will establish the fund. By establishing the fund, we mean the company will decide who is going to be in charge of that fund, who's the custodian of that fund, and the company would also decide on the size of that fund. That's the first step. And then you have when you make payments. So you start making payments from that fund. Again, like for example, you bought pizza, you're going to use that petty cash fund to make the payment. You want to post or mail a letter, you're not going to go through the approval to mail a letter. Instead, you're just going to pay for the postage cost, right? So you make that payment, okay, from that petty cash fund. And then the last step is when, at the end of the month, usually it's like 3 to 4 weeks, the company would replenish the fund to its original size. For example, let's say that the size of the fund was $1,000. At the end of the month, it will be replenished to $1,000. It is at that moment where the journal entries are made. The companies will not be making journal entries after every payment. They just keep the receipts. Okay? They keep the receipts and the information about each payment, documentation for each payment. However, at the end of the month, they will, when they replenish the account, this is when they will actually write the journal entries. So let's see how this is recorded. You see, with the voucher system, you record the liability in the same way we used to record it before. You buy something on account, okay? You buy a TV equipment on account. What do? You debit equipment, you credit accounts payable. That's how you recognize the liability. And then when you pay it in cash. So you credit cash and you debit accounts payable, right? This is how we record it. This is how we record them. So it's the same way as we used here. We just were explaining about the controls. How companies make sure that the payment goes to the right person. With petty cash fund, it's a little bit more flexible. So let's say that the company decides to establish a $100 fund on March 1st. The account that will be used is called petty cash, okay? What happens to petty cash? It increases. What happens to cash? Decreases. So you debit petty cash, you credit cash. Okay? When you want to replenish it, so during, like I said, during the month, it will be used for different things. No journal entries will be made at that time. Journal entries will only be made at the end, when the information is sent to, for example, yes? Any question? Okay. So this is where, for example, the information is sent for verification. Once it's verified that it was paid and that the receipts are available, the company will replenish the amount, okay? So let's say it was $100, right? For the petty cash. They request $87 to replenish. Basically, how much did they actually have in the drawer? They still have, the fund contains $13 cash. The replenishing of the petty cash fund is always the original size minus whatever is left in the drawer. You will see why I'm saying that in a second. So in this case, it's $87. The documentation that is accompanying this will be receipts for postage, $44, straight out, $38, and miscellaneous expense, $5. Okay, the total will be $87. In this case, what's happening to cash? Sorry? Cash, because the amount, how much cash is the custodian of the fund requesting? They are requesting 87. That's the amount that will be credited to cash, right? And then you have the other expenses. You debit the expenses, you credit cash. Why aren't we using petty cash fund? Why are we using cash? The petty cash fund, the account petty cash, was used only for to establish that account. After that, bless you. Basically, what you're saying here is that the company, it's as if petty cash was never used. In this case, what we're saying here is that we still have the petty cash as is, because we're replenishing it, okay? However, the payments are made all in cash. That's how you record payments made through the petty cash fund, okay? You debit the expenses where you use the money from the petty cash fund. In this case, it's postage expense, straight out, and miscellaneous expenses. The total is 87. This 87 here is 100 minus the 13, which are in the drawer. It doesn't have really to be a drawer. I'm just making it simple. This is whatever you have. Because in certain cases, what happens is that you might lose some money. What if you dropped $5 from your pocket? You went to mail a letter and you lost $5. How much would you have in your account? $13 minus $5. You will only have $8, right? In that case, how much would the custodian request to replenish the account? 100 minus 8. 92. Basically, what you need to do is to have the fund, the petty cash fund, the balance should be 100 after replenishment, regardless of what money was lost or what money was found. So let's take this example. Assume that in the same example, instead of having $13 basically in your drawer, you had only $12. That means there's $1 that went missing. Okay? It's the custodian's job to make sure that no money was missing. However, things happen in life. Maybe someone dropped that dollar from their pocket or something like that. The same expenses are there. We will debit the same expenses, the amount that were paid. We credit cash 100 minus whatever is left. So cash will be credited 88. This is 100 minus 12. This account here, cash over and short. This is the account that the company would use to record any shortage in the money, any shortage or any money that is over. Because in certain cases you might also have $14. How could that happen? Maybe I paid extra and I forgot to ask for reimbursement, or I thought that it's not worth it to ask for reimbursement. So the petty cash fund. So like for example, if you pay something for $1, so like you want to mail some letters, you thought originally that it would be 40, or let's say that it was $46, you just ask for $45 as reimbursement. So the drawer would have an extra $1. Now, when we have a shortage, you have to think about it as an expense. It's a loss, right? The company lost $1. Like in this case, the company basically lost $1. So it will be reported as under other expenses, right? Or miscellaneous expenses. And if there were an extra $1, it's as if the company made $1 profit, right? So that extra $1 would be reported as a revenue. The same account could be either way. So for example, the company established a $50 cash fund. On July 30th, the fund had $12 cash remaining and petty cash receipts for 14, 10, and 15. We need to prepare the journal entry first that would record the establishment of the petty cash fund. How do you record petty cash fund? You always debit petty cash, credit cash. For $50. In this case, they are asking us to do that for $50. And then the account is to be replenished on July 30th. So the journal entry on July 30th is to replenish the account, the petty cash fund, to $50. Okay? How do you replenish it? How much did you start by listing the expenses. What expenses do we have here? Sorry? Postage, 14, office supplies, 10, and delivery expense, 15. What's the total of these three? 39, right? So how much should the company put into that account, into petty cash, to replenish it? So this is equal to 39, right? Cash will be 50 minus 39. It should be how much? 11. Right? Am I correct? Wrong. What did I say before? You always look at what you have here. How much do you still have? So this is wrong. What you actually ask for cash is 50 minus whatever you have in the drawer. In this case it's 12. That would be 38. You cannot have in petty cash more than that. If you replenish it 30, if you get 39, you would have 51. That's not correct. In this case, you have cash will be always what's in the drawer. It's the original size minus the drawer. So it will be 38. The difference, do you have an extra dollar or you lost a dollar? Extra dollar, that means that the company made an extra dollar. When the company makes an extra dollar, it's a revenue. So you treat cash over and short as a revenue. When revenues increase, what do? You credit them. In the previous example, the company had lost a dollar. So we had treated cash over and short as an expense. Okay? Any questions? Now we'll talk about banks, using banks. And companies use banks a lot. Why? Because it's not safe to keep all the money in their accounts, right? Instead of keeping the money in their vault, which is a risk someone can basically break in and steal it. They will keep it in a bank where they have much safer savings, right? And they are responsible for the money that you have deposited there. Plus, the bank statement itself will work as another control, because you can look at the bank statement and use it for reconciliation. Let me tell you something. Do you think that most of the time you would have the bank statement, the balance of your cash account according to the company's book, and the cash balance according to the bank? Would those balances be the same or different? What do you think? Do you think that most of the time the balances per bank and the balance for the company's accounting system, by the company's books, would they be the same most of the time? Frequently? Never? Seldom? What do you think? The cash balance, your cash account. Here we're only talking about cash. Your cash account. And you also have the cash, basically the cash account is in your bank, right? The cash account is in your bank, is in the bank. But you also keep records on your accounting system, right? So whenever you make a payment, whenever you receive a payment in cash. Which one, do you think that both are the same? No. Why is that? Okay. That's correct. Most of the time it's not the same. Why? There could be human errors. That's correct. It takes some time to process it at the bank. So both answers are correct. Okay. Now which balance would be the correct one? Is it the balance according to the bank or the balance according to the company's books? Which one is the correct balance?
What do you mean by correct? Like, correct as in accurate or
Correct as in accurate. Well, accurate, no. Accurate is different. Both of them could be accurate. But which one is the real cash balance? Is it the one in the bank or is it the one according to the company's books? Sorry? Okay, so Cliff says it's the company. Who says it's the bank? So who says it's the bank? Raise your hand. The company. Actually, it's neither. Both of them are wrong. And wrong for a certain reason. We will see that. This is why usually you have bank reconciliation. And trust me, if you are trying to get an internship or a job as an accountant, one of the first things they will ask you to do is to run, to do a bank reconciliation. And if you don't know how to do that, they will kick you out. Well, that's real life. The reason why both are actually incorrect is that both of them would have unadjusted balances. We need to adjust those balances to get to the adjusted balance. Now, unless there was a mistake or stealing or anything like that, the adjusted balances should be equal. So the adjusted balance, after we run this bank reconciliation, we will see that in a second. So let's do that. Okay, you guys know the answer. What? I mean, that was an easy question. You did know. Okay, so let's do it. Okay? I'll give you. Yeah. But I'm not giving you a lot of time for that. Go ahead, you have 30 seconds, so we're fine. Control features. Other bank accounts do not include. And trust me, it always happens. Please don't do anything silly. Okay, so unbelievable. Okay, so I will give you a smiley face and a star because you got 99, except the 1%. Those will get. And it's actually, I don't know, give me 1 second. It will be fuming, I don't know this. Okay. Reconciling the bank account. The reason why we have different balances, unadjusted balances, is that the company, as soon as they send out the check, they will mark that as a payment made, right? This is how they record it. You send out the check, you consider that the payment is made, right? However, there will be some kind of a lag between the times you send the check out, your supplier or the company you're paying, they would receive the check, they would process it, send it to their bank will send it to your bank for verification that you have enough funds, and then they will credit their account. Right? And at that point, it is at that point where the bank will deduct it from your balance, right? There's usually a lag between the time you actually send the check and between the time you actually see that the bank deducted that from your balance. This is a lag. This is what we call outstanding checks. Those are checks that the company wrote and sent out. However, the bank still has not processed them yet. Another kind of lags would be the time between the time you deposit a certain amount. When you deposit the money, it takes usually 1 to 2 days, etc., depending on the speed of your bank. But it takes some time before it is actually reflected in your account, right? Have you ever deposited a check? It takes sometimes a couple of days to deposit the checks, right? Those are deposits in transit. You deposited them as far as you, the company, you are the company. As far as you are concerned, you have received the money. So you will actually debit your cash account. But in reality, the bank has not added them to your balance yet. There are also certain bank charges that that you will not see as an accountant. You won't see until you receive the bank statement. So the bank will have charged you that amount, but you won't see that until you receive the statement. There's a lag. There's a delay between the time the bank charges you those like if you requested I don't know, checks, for example, they will charge you for that. There will be a delay between the time they actually charged you and the time it shows on the statement. And plus, in addition to that, there are always errors. Okay? In the same way that if the bank makes an error, you send a check, or you want to deposit a check, and the employee there, the clerk, types in the wrong number. Okay? So you sent out the check, someone types in the wrong number, that would create an error at the level of the bank. If it were the company, so those are from the bank's perspective. So basically, to do the bank reconciliation, what you do is you do two things in parallel. You start with the bank's unadjusted balance, and you have to adjust it to get to the correct one, or adjusted balance. Then you go to the company's books. You look at whatever you have according to the company's books, and you make the adjustments to those ones. So for the bank, you have to look at the deposits in transit. Those are the amounts that the company has deposited or not. You also have to look at the checks that the company wrote, sent out. Those are outstanding checks before the bank actually clears those checks. You have also all the charges, bank memorandum. Okay, and finally you have to look at the act. So this is, you see this one? I want you guys to take out your phones and take a picture of it now. Come on. What, now you don't like your phones anymore? It's a lot of work, not when you're texting or you're updating your Facebook account, right? So, just take the picture. This is what you will be helping me with later on to see how we get to the adjusted or the correct balance. Okay? I know, my mistake. Sorry. So this is the one. Basically, you start with a bank account. With a bank account, this is the balance according to the bank statement. You add deposits in transit. Why would you add deposits in transit? This is the money that you already deposited, but the bank statement has not reflected yet. So you have to add those deposits in transit. You also need to subtract outstanding checks. Why? Because those are payments that you made. The bank simply has not cleared them yet due to processing lag, but those will be deducted soon. Remember, what you are trying to do is to match the payments, revenues, expenses, everything within the same period. If you make the payment today, you recognize it today according to your books, you need to adjust it on the bank according to the bank's balance. You have to adjust it so that it would fall within the same period. Okay? The last one, you have to fix any errors. This is correcting entry. This is where you make a correcting entry, like we did before. The easiest way is always to reverse it and just enter the correct one. So this is the first step. You start here, this is one part. In parallel, you also do the one per books, according to the company's books. Now, according to the company's books, in certain cases, the bank would work as a collecting agent for you. So you give them the note, the bank will collect that note receivable on your behalf. This is what we call notes collected by the bank on your behalf. You did not know yet that they were collected. Okay? According to the books, you still have not recorded the collection of notes received of that note. So you have to add the value of that note, including if it has incurred any interest, you have to add it. So you add the notes collected with their interest. you have to also subtract NSF checks. NSF checks are not sufficient funds. This is where you don't have enough funds, not you. Those are checks that your customers paid you, you deposited them, but it turned out that the customer did not have enough funds in their bank to cover that check. What happens? The check will bounce. What happens when the check bounces? Yes?
You don't get all your money.
You don't get the money. So let's say that I buy something from Best Buy. I give them a check. Best Buy will record it as a payment, right? And they will send the check to the bank. I buy something from Best Buy on account 2 weeks later to settle my debt. What's my debt? It's account payable to me. What's my debt to Best Buy? Account receivable, right? So the company, Best Buy, now you are the accountant for Best Buy. You send me the bill, I send you the check. To you, my account receivable, Hussein, that account receivable has been settled, right? Because of the payment of the check. The check bounces. What do you need to do? You have to reverse it. You have to say again that, okay, so the settlement of Hussein's debt did not actually happen. So you have to reverse the settlement of that debt. So what do? You have to deduct that amount from cash because you thought you received that cash. It turned out to be that it was not valid. Okay? It was not valid, so you have to deduct it. So you deduct any bouncing checks, any NSF checks. Okay? There are also other service charges, checks, printing, etc. from the bank. The bank might also charge you for interest, etc. So those are different expenses that the company will have to adjust their cash account for. And finally, you have to fix any errors. If your accountant by mistake entered the wrong check amount, in the same way as we did before, a correcting entry must be made. Is that clear? You do that in parallel. For the bank statement, basically for the balance per bank, you add, first thing, you add deposits in transit, you subtract outstanding checks, and you correct the errors. That will lead you to the correct balance. On the other hand, now in parallel, you also do the company's books, the balance per book. According to the company's books, you have to add any notes that were collected by the bank. You subtract any bouncing checks, and checks that bounce. Remember, those are not the checks that you wrote. Those are the checks that your customers paid you. Okay? You have to understand that. So those are checks that you deposited, but they bounced. And then you have to also subtract the charges that the different charges that the bank added to your, basically charge you over that period. Finally, you correct any errors that you made during that time. So let's see. Let's do this example here. So the bank statement of Laird Company shows a balance per bank, 15,907. On this date, the balance of cash per books was 11,589. Using the 4 reconciliation steps, those are the ones that the company, basically those are the ones that the company identified. We need to do the reconciliation, the bank reconciliation. You start this side, for example, you do the bank. So this is balance per bank. This is balance per books. Let's do the bank first. You always start with the unadjusted balance. What was the unadjusted balance? 15,907.45. Look at the pictures that you took. What do you do now? Come on, come on. That's why you took a picture of the screen before. Yes, Baba. We add deposits in transit. So we have the deposits in transit. You add 2,201.40. Next. You fix before that. Yes. Subtract outstanding checks. So minus 5,904. And then you fix, like Cliff said, what do you do? You fix bank errors. Do we have any bank errors here? We do have errors. Who made the error? Laird wrote check number 443 for 1,226 and the bank correctly paid that amount. Who made the mistake? The company. So you do not, when the company makes a mistake, you do not include that error correction for under the balance, okay? So now, who can use your calculator to tell me what's the actual adjusted balance per bank? Come on, go ahead. I know I have very bad handwriting, but you can still read it. Come on, use your calculators. Sorry? Sorry?
Is Joanna Marmello here?
I can't hear you. Bounce.
Sorry.
I'm sorry?
Oh, there we go. You're sorry. My bad.
Okay. In a way, it is. So, go ahead. 12,000? So it's 12,204.85. Okay? Now, we have to do the other side per book. Okay? So per books. How do you do that? You start with with the balance per book. You always start with the balance per book. Which is 11,589.45. Next, what do you do? Come on, you all took pictures. I saw you. Okay, so start by doing, okay, so NSF. What do you do with NSF? You have to subtract NSF checks. So minus 425.6. You have also a charge for printing. You subtract that, so it's minus 30. And then you add 1,035. Can anyone do the math here? Can anyone just add them and see? Sorry? No, you don't think it's that number. You have to do the math. Because if you made a mistake, this is where you actually get a different number, right? So, do the math. Someone calculates it. Yes. Exactly. This is why you don't do that. Because if you do the math, and I want someone to tell me what the number is. Now is the time to use your calculator on your phone to do the math. Go ahead, someone, come on.
Okay,
12,000? Okay. 485. That's a different number. That means there is a mistake somewhere. Okay? So that means that there was a mistake somewhere. So let's fix it. The mistake was here, right? The easiest way, when you have an error, and here you're only looking at the cash part of it. Cash, and I'm only looking at this one here. The company wrote a check for 1,226. However, Laird recorded the check as 1,262. The company wrote the check. That means they made a payment. So originally, they credited 1,262. Okay? The easiest way to do that is to reverse it. Basically, you need to do the correcting entry. The amount that you need to have at the end should be 1226. What's the correcting entry here? What's the correcting entry here? Sorry? Exactly. So here it's not going to be on this side, actually. It's going to be on the other side. It doesn't matter. Oops. So this is where it's supposed to be. Right? This is the amount. How much are you supposed to? 36. We need basically to subtract 36. Now let's do the math again. 132 points. Where's the mistake here? Yes. Exactly, you're supposed to add the cash. You're not supposed to subtract the cash. You debited cash. Okay? So when you're doing this one, most of the time people make mistakes when they are correcting errors. So the easiest way to do that is, if you want, you can simply reverse that transaction. Just do the correcting entry. But you have to make sure that this is actually, it's actually plus 36. So now, let's do that. Add the numbers again. See if the numbers are correct. Okay? Did you calculate it? Right. It's actually now you're adding 36 plus 36 because you have subtracted that amount. 72. So try it now. Is it correct? Is it the correct number? I've seen you use your phone. You're much faster than that. It is the correct number. So it should be 12204. 12204.85. Yes.
Why did you add the 1,035?
Okay, so the $1,035, this is when the bank collected a note receivable on your behalf. And until that moment, you did not know, until you saw the bank statement, you did not know that the bank actually collected it for you. So now you have to update your books to reflect the collection of note receivable. The bank collected 1,000, that's a face value of the note, plus $50 interest. When the bank does that, it does not do that because they love you. They want their commission. They will charge you $15. In this case, it will be 1,000 plus 50 minus 15. The total will be 1,035. This is basically the net collection on that note receivable. Okay? So this is what happens. And this is where you actually have those amounts. Now, this is the balance. This is the same thing. You start with one part, and then you do the second. You start with the bank, you do the company. Basically, you have to do both of them in parallel. Anyone has a question about that? This should not be difficult. It doesn't take you time if you follow the steps. Unfortunately, in the exam, you will not be allowed to take the picture with you. So you will have to understand basically which ones will go to correct the balance per book, which adjustments you need to make to correct the balance per bank statements. Okay? That's the trick here. Any questions? Okay. Now we are going to look at the entries that the company will have to make. Basically the correcting entries. So, not the correct entries, the adjusting entries to do both. Remember, the company will not make the entries for the bank. They will only make the entries for the company itself. They don't have any authority to make any changes to the bank itself. What they did was they made changes to the balance, like to the statement. but not to the bank's books. So collection of note receivable, this is what we just said. The company basically they will make an adjustment to recognize the collection of the note. They received cash. How much? Net it was 1,035. That was for the note receivable of 1,000. And then you had interest revenue 50. The commission charge or the service charge that the bank charged the company for the collection, it goes under miscellaneous expense. That's the $15. This is bank charge. Okay? So that's how you make the journal entry to recognize the collection of the note receivable. And then there is the book error. Okay? We needed to correct that book. What did we do? We added $36 to cash. When you add to cash, what do? You debit cash, credit, accounts payable. Because basically what were you doing? The company thought they paid more. The company thought they paid more debts to complete the sentence. However, it turned out to be that they did not pay as much debt as they thought. As a result, they had more cash, but they also had more liabilities, more accounts payable. So we need to increase both. We credit the liability to increase it. When you have a bounced check, you need to reverse the entry of the payment. When you receive a check or a payment from your customer, what do? You debit cash, you credit, account receivable. Now you're saying that, okay, that payment did not happen. How do you make it? It did not happen. You make the reversing entry. You reverse it. So you debit account receivable, you credit cash. For the service charges, those are just regular expenses. In this case, we have miscellaneous expense, $30, and that was paid in cash. Any questions? We have, so let's see what we have. The bank, the company, they wrote a check. When they say they wrote a check, so when you say here a check correctly written by the company, okay? So the company wrote a check for 491. Okay? That was correct. That's the correct amount. The bank correctly and paid. It was correctly paid by the bank. So the error is at the side, is at which side? The company. The company made the error. They incorrectly recorded that as a payment of 419. So what was the journal entry? The incorrect one. So the incorrect one was what? It was credit to cash 419. The way to correct it, just always do it in the same way. That's my advice to you guys so that you avoid any mistakes. Bless you. Reverse this one. How do you reverse this one? Debit 419. Now your balance is what? 0. You need to get to a balance of how much? A credit for 491, right? Credit 491. So what did you do here? You debited 419. What does it mean? Plus 419. You credited 491 minus 491. What's the difference? Minus 72. So you subtract 72. That's the easiest way. Okay? Can you guys see it or is it not clear? So what you do is you look at the debit and the credit. Yes?
Why can't you just say it's 72?
Sorry?
Why can't you just
You are not, but this is the thing. The company basically wrote that they made the payment for 419. So this is the thing. The company thought that they paid 419. However, in reality, they paid 491. Let's say that originally the balance for the company was the balance of the cash. Let's say assume cash balance unadjusted. Cash balance was $1,000. You thought that you made the payment for 419. You thought you had 1,000 minus 419. How much would that be? Come on. 581. In reality, how much do you actually have? How much did you actually pay? You actually paid 1,000 minus 491. That would be 509. That's how much you actually have. But your books, they show 581. How do you get from 581 to 509? By subtracting 72. You thought you had 581. In reality, you had 509. You have to adjust your book. So what do? You have to subtract the difference. Yes?
Well, wouldn't it, I just thought it would be different because it says written paid by the bank.
The bank, why would the bank write a check on your behalf? What? Who writes the check? The company. Who pays the check? Who writes the check and sends it out? The company. Who actually pays the check? Turns the check into dollar bills or pays the check? It's the bank. So basically you can hear written by the company and paid by the bank. Okay? If you're still kind of confused about this one, just try to review the correcting entries. This is basically just a correcting entry. There comes blah, blah, blah. Cash equivalents. So cash equivalents are sometimes like treasury bills. Those are assets, current assets that are highly liquid to the point where you can immediately convert them to cash. In many cases, companies, they don't just list cash. They list cash and cash equivalents. Okay? Now, this is simply to show that on the financial statement, you would have cash and cash equivalents. You also have another account, which is called restricted cash. This is cash that the company has. However, they do not have the right to use it like in any way they want. It is restricted it has a restricted use. Basically, like sometimes companies, like airplane companies, they have to keep a certain amount of cash as collateral for insurance, etc. Okay, and sometimes it's for lawsuits. We will learn later on, sometimes for mortgage, in order for you to land a certain mortgage. Basically, if you are asking for a loan, you might have to put some kind of an amount of cash that is set aside. It's restricted. Okay? We will do that in the future. Basically, we will see how we can have this reported in the financial statement. But basically, you would have cash and cash equivalents. Then you have short-term investments, and after that, you have the restricted cash. Restricted cash would be listed separately from cash and cash equivalents. Okay? Okay, skip. Journal entries are required by the depositor for all of the following except collection of a note receivable, an NSF check, bank service charges or bank errors. bank errors, because it's not, this is on the, according, the bank will have to make those adjustments, not you. Your accountant will not make a journal entry for the bank error. The bank will have to make an entry for the bank error. Okay? So, Amy Company assembled the following information in completing its July bank reconciliation. Balance per bank, etc., etc. As a result of this reconciliation, what would Amy do? Okay, so how do you solve a question like that? You do? How do you solve the question like that? What you do is, you do the reconciliation. So you start with the bank. So, no. Okay. So you start with the bank. So for the bank, started with the beginning balance, with the unadjusted balance, 15 to 80. What do you do then? Next, you have outstanding checks. What do you do with outstanding checks? Subtract them. Then you add deposits in transit. So what's the adjusted balance? Sorry? Yes. 17,180. Now, for books, we start with 17,600. What? So we did this one, we use this one. NSF, when you have an NSF, what do you do? NSF checks, you subtract them. Bank charges. Cash balance per book was 17,600. What were the adjustments? What did the company do? What are the adjustments that the company did? They subtracted 320 and subtracted 100. So they subtracted minus 420. Any questions? Okay. The next thing we will start talking about today is receivables. We have been talking a lot about receivables, mostly about accounts receivable. So in this chapter we will discuss accounts receivable and notes receivable. So let's start. Usually there are different types of receivables. The most common ones are accounts receivable, and we have also notes receivable. Accounts receivable are when the company makes a sale or provides a service on account. This is money that their customers owe them. Okay? Notes receivable are very similar. Usually they have a longer periods of time and they have a more formal documentation. Plus, most of the time they actually incur interest. They lead to earning interest by the company. So the company, because they have notes receivable. We saw that in the bank reconciliation. They collected notes receivable, they received interest on that because of that as well. And then you have additional other receivables basically. Those are like from tax refunds. Those are money that the company lends to their employees and they expect them to pay them back, etc. Okay? Sometimes they have also an interest receivable. This slide here simply shows you why we care so much about accounts receivable. Because in certain cases, it makes up a big part of the company's current assets. Okay? This comes from the company's operations. And most companies, they actually make transactions on account. So this is why you would have, for example, General Electric, they would have 52% of their assets were 52% of their assets, like half their assets were in receivables. Okay? So for accounts receivable, there are three main issues that are associated with that. Now, the first thing is you need to know when to recognize them. That's easy. Right? When do you recognize an account receivable? Either when the company makes a sale or provides a service. When the company earns their revenue on account, if they provide a service on account, you debit accounts receivable. If they make a sale on account, you debit accounts receivable. The second part is a little bit trickier. Valuing accounts receivable. And why is that? So we know that we are going to report it, but at which value? The problem with accounts receivable is that part of those receivables will never be collected. You will always have some customers who default on the payment, right? So instead of making the payment, instead of paying their debt, they might go bankrupt. If your customer went bankrupt, they are not going to pay you the money. Or there is a possibility. It's not for sure, but there is a possibility that you will never collect that money. So this is what we talk about when we talk about valuing them. Okay? So let's start with this one. Assume that the company sells merchandise on account to Polo Company for $1,000, terms 210 net 30. You need to prepare the journal entry to record that transaction. You made a sale on account. So what happens? You debit what? Accounts receivable, you credit sales revenue. Now later on, the customer returns $100 worth of merchandise. Now the money that you expect to receive will go down by 100, right? By the way, here, although we're making sales, we are not looking at the second part. Remember, we usually make two transactions. The first one to recognize the sale, the second one, cost of goods sold and inventory. For the sake of making it simpler, we're not looking at the second entry. We're only focusing at this one on the receivable. Okay? So in this case, the company will return, and when you have sales, returns and allowances, that's the contra revenue. What do we credit? Accounts receivable. We did that before. This is why I'm going fast, because we did all this before. Okay? So what we did, the company or the customer returned to the company goods that are worth, basically the sales that were sold for $100. Okay? On July 11, the company also received a payment. That was within the discount period, right? So, how do we used to do that? Cash would be the full amount minus the discount. Then we have sales discount, okay, which is, it's 2% multiplied by the net sales. Remember, not the ones that will return. Accounts receivable will be credited the $900. Okay? Now, in certain cases, there are certain retailers who might issue their cards. So basically, you have those sold cards, right? Macy's does that, JCPenney, etc. And if by the end of the month, if you don't make the payment, they will charge you a certain interest. Okay? Now, if you use a credit card to make the purchase, that will be, again, it's a purchase on account. So what happens? How is the entry made? It will be, again, for JCPenney, it would be sales revenue and accounts receivable. At the end of the month, if they don't make the payment, what will happen? If you are the customer does not make the payment, JCPenney will earn interest. The interest is 1.5%, for example. So they will have interest. Basically, this is interest revenue. But because you haven't paid, if you haven't paid the full amount, you're not going to pay the interest. They will charge you interest. It becomes accounts receivable as well. In this case, their accounts receivable will be the original amount plus the interest that was to be paid, that is to be paid. Any questions? We will continue about the valuations on